Now, let's focus on the currency. The currency has found some support and has pulled back from low levels seen last week. At this point of time, trading around 68.1 to the dollar, 19 to the dollar, so absolutely flat. To talk to us about currency, fund flows and interest rates, we are joined by Ashutosh Khajuria. He's ED and CFO at Federal Bank. Mr. Khajuria, thank you so much for speaking with us at NDTV Profit. Now, the dollar has been overall strong, but previously also in the face of a strong dollar, the rupee has stayed pretty stable. This time around, we saw it weakening significantly towards 68.86, which was the most recent low. What's in store for the currency?
See, my call is that once, this particular uncertainty about the outflows, and these outflows have culminated out of some fears that the economy would slow down, and this was compounded by FCNR, redemptions. Because already people were talking about it 3 months back, right from September, people had worries how these redemptions would be met and what would be the impact on currency and rupee liquidity. Now, rupee liquidity, in fact, on the other side, because of demonetization also, increased like anything, and in fact, the measures were taken by RBI on the other side. Rather than injecting equity, they were so flushed, the system was so flushed with liquidity that they had to mop it up. First through their liquidity adjustment facility, repos, reverse repos, and then thereafter followed by the additional CRR from the banking system. On the currency side, if you see, the entire redemption is now over, because the last of it, the last bunch was due on 30th November, and that also is about 5 days back. And we see that our results have not been impacted. We have yet to see the last Friday figure, because the one which we saw on Friday was a week older. So let's see, I think the next Friday, the coming Friday, 4 days from now, we would have the actual, impact of the FCNR redemption. You have to see our results, how much they have fallen or so. But this last installment is not going to impact much, as is suggested by the move of rupee vis-a-vis dollar. Rupee is holding the fort, and when you compare it with Indonesian rupiah, Brazilian real, I think it has done very well, fairly well. We are just seeing rupee vis-a-vis USD. Let's also see it vis-a-vis euro, yen, sterling pound, and pair currencies. So I think rupee has rather appreciated a bit, and if I'm not mistaken, going by the RBI RER index, rupee is slightly overvalued at about maybe 105, 106 on the index.
Right. Mr. Khajuria, then the FCNR redemption pressure is going to get out of the window soon enough. But when it comes to the uncertainty about growth and the impact that demonetization will have on near-term growth, what kind of selling pressure from FIs is still expected?
See, I think the apprehension or the fears sometimes, react in a panic form, and they are sometimes overdone. So I think gradually what people are giving the feedback is that the 90, in most of the sectors, 90% normalcy has already returned. There are some areas where, like real estate and perishable goods. In those cases, slightly the impact is yet to be fully, annulled. But I think as we are moving forward, I think there is, earlier there was a fear that so much of currency would be lost in the process, and if currency is lost, it would give impact to, slow down, because currency also at times fuels growth. But then as we see now, I think the old currencies practically would be at least 85 to 90% would be back. And if that be the case, I think over a period of when replacement of currency happens, there will not be much of an impact.
Mr. Khajuria, you could also talk to us about the RBI policy that is there this week. What do you expect, first in terms of the cut or, the change in the rate cut, and second, you expect any additional measures to be announced regarding liquidity, what's happening, commentary on commentary for RBI policy, their projections for growth would all be particularly quite important this time?
There are three areas I see that would be definitely covered in this policy. One would be, of course, the policy rate. And market expectation is about 50 basis points as reflected in 10-year GSEC yield. The 10-year GSEC benchmark yield itself is suggesting that market is building up a case for 50 basis points cut. Now, in between, I think the 10-year benchmark, the new 10-year 6.97%, 2026 paper, had already dipped to yield-wise to 6.11 intraday. And 6.11 simply suggests that from 6.25, they are expecting policy rate to go to 5.75%. I'm talking of repo rate. So I think 25 basis points, there is almost unanimity in the system. Of course, central banks all over the world surprise the markets at times. I don't know. I don't want to comment on that. But I think 25 basis points is surely, accepted as a sort of consensus in the market. But some good chunk of people also believe that the loss of growth may be compensated by creating one additional tool of interest rate, and that could be the policy rate reduction to the extent of 50 basis points. And as regards the second part, which is going to be covered, is going to be on the liquidity mop-up, as you rightly raised that point. Additional CRR, which was announced, is resulting in maintenance of about 104% CRR on the additional amount of deposit between 11th of November and 16th of September. 104% because 4% was normal one and additional 100% was required as a temporary but extraordinary measure. Now, there is definitely going to be some change in that. It could either be fully taken back because now MSS is in place, or at least, a good chunk of it would be reversed. I don't know what quantum that RBI would be in a better position to take stock of the macro level liquidity situation. But I think it's unnecessarily bleeding the banking system, which already is under pressure because of the digression or rather diversion towards, the currency management for a pretty long time now. Almost 4 to 5 weeks. But overall, I think because it's a very good step in long run, and it would help economy in a more cleaner way, more revenue generating, less of the hidden wealth and all these things would be better. So I think there's no doubt about it. The objective is very good. Only thing is it may have its temporary setbacks. So that's it. I think two areas are this, and third one, of course, is the
credit growth. Do you expect the slowdown to continue, which can lead to banks reducing rates, even if RBI does or not?
I beg your pardon?
In terms of credit growth, do you expect a further slowdown, which means the rate in the system could come down further, even if RBI were to do a modest rate cut?
I think if rate of interest is used as a tool, and therefore you have an aggressive cut, which I'm saying at least 50 basis points or so, then I think it would take care of the fence sitters who were looking for investment, waiting for the right rates of interest. And I think now when U.S. interest rates are likely to go up, and there is some consensus, I think if the rate is cut, I think it would give rise to more of drawdown from Indian lenders. Because then overseas borrowing may not really be beneficial or may not create some arbitrage. Though forwards have come down drastically, but still because LIBOR has moved up and in anticipation of Fed rate going up, you would have, lesser benefit being left even for those who have a self-hedge and all to really go overseas and borrow. So I think Indian lenders that way, in rupee terms, they should have a better drawdown coming in the coming quarter. That's Q4.
Right. And in terms of, banks benefiting out of this, firstly, you expect that 10 to 15% of the deposits that come in will stay back with the banks, and that's why their cost of funding could decline. And secondly, more people now would be inclined towards more banking transactions.
Absolutely. If the banking habits improve, India, everybody had been saying, is an underbanked economy. So if this particular measure can push the banking habits in the system, in the society, then it's not only socially very, very good, it would be economically good for the banking industry.
Right. And in terms of, credit growth picking up, things getting normal? When do you expect things to start becoming normal?
My expectation is, I think it may take maybe a couple of weeks more. By December end, I think this should fully settle. And I think Q4 would start with new vigor, with new energy and all that.
Mr. Khajuria, will the market be greatly disappointed if the RBI decided to stay on status quo and not do any rate action, given that the differential between the Indian yields and the US yields is narrowing, and perhaps they'd wait to see what happens in January when Donald Trump takes over?
Manisha, the chances are less just because if you see the CPI numbers, they're already 4.20 for the previous month's reading. And when the November reading comes, I'm expecting it to be below 4%. Now, if you have that below 4%, there is no reason why you should have repo rate at 6.25. So I think if you just look at the macro numbers and going forward, you're not seeing any agent which is going to, or any vulnerable which is going to push the prices up, and at least not in near future.
But we must also keep in mind that we've seen a big crude oil spike, and hence our import bill, we will be importing some inflation as well. So don't you think that will also have to be factored in, plus the stronger dollar?
You are right on that front, but please remember that I think with great difficulty, this, OPEC and even non-OPEC members could see that oil prices were pushed above $50. So I think with, more coming from shale as the prices improve, there is a counterbalancing mechanism already there in the global oil market. Now, coming to India, yes, it does impact our WPI more. Because fuel has about 14%, 13 to 14% weightage in WPI basket. But overall impact in CPI basket would not be that much. And plus, simply oil pricing going up may not result the entire pass-through coming to the retail market, means the retailing of oil products. Reason again is because when the prices are falling, government can increase the excise duty multiple times. So that must have been a cushion. So when the crude prices go up, they always can look at, because it's ad valorem, when the prices move up and they cut the excise rate, their revenue would not be impacted, because you have at a higher price with a lower excise duty. So I see more stability in oil prices with the present mechanism. So I don't see it as a very big risk on CPI and WPI both.